There are four main stock market order types: market orders, limit orders, stop orders, and stop limit orders. In this video, we're going to explore what each one of those is, what the difference between each of those stock market order types are, and how to choose which stock market order type to select when you're going to place an order. How's it going, everybody, and welcome back to the channel. If it's your first time here, my name is Jay, and today we're talking about stock market order types. Now, I did a prior video examining market orders versus limit orders. A market order will simply be whenever I press that confirm button to buy the stock, I'm buying the stock at whatever the going price on the market is at that second. So if you're not familiar with market orders and limit orders, check that video out first. It's down in the description, and then come back to this one because I'm not going to spend much time on those here. But quickly, a market order is when you place an order and it fills at whatever the going price is at that moment. A limit order is when you set an exact price that you want to buy or sell a stock at. If it's trading at $100, you say, I want to buy it at $98.25. You enter that in as your limit, and when the stock hits that price, your order will execute. So the first stock market order type we're going to discuss in a little detail here today is a stop order, or more commonly referred to as a stop loss order. A stop loss order is usually used when you want to protect yourself from losing too much on a stock. You want to set a price at which you're going to bail from the stock. So for example, say I was trading in a nice, stable, blue chip stock like GameStop. I bought GameStop at $30 and the price quickly rose to $100 per share. Now, I know it's a volatile stock. I don't want to lose everything I've invested in it, so I want to protect myself if the stock price comes crashing back down. So I could set a stop loss order for $60, and in the event that the price of GameStop comes crashing down, once that price hits $60, my stop loss order will then turn into a market order and automatically execute selling my shares of GameStop. Now, the reverse can also be true. If you have a short position, you can set a stop buy order, which is just the same thing in reverse. You set a price above where it is today, and if the stock price rises, you'll buy shares at that price. So a stop loss order sounds a lot like a limit order, doesn't it? Well, what's the difference? And the first difference is, with a limit order, your order is public. So if a stock is trading at $100 and I put in a limit order for $98.50, so whenever $98.50 becomes the going rate for that stock, your limit order will execute at exactly that price. With a stop loss order, on the other hand, your order kind of stays between you and your broker initially. So if that stock is trading at $100 and I set my stop loss for $95, that's just between me and my broker. So if the stock price begins to fall, and once it hits that $95 stop loss order that I've set, that stop automatically turns into a market order and will trigger at that moment. Now, the key difference there is, with a limit order, your order will execute at exactly that price you set. With a stop loss order, you set the price you want the order to trigger at, but since it turns into a market order once it hits that price, there's a risk that it will actually execute slightly below the price you've set because it turns into a market order, and depending on how volatile that stock is and how fast the market is moving, it could blow right through that stop loss in the time it takes for that order to execute. So think of the stock market kind of like an auction. The price of the stock in this case doesn't move up and down in neat predetermined intervals. It doesn't go penny by penny or dollar by dollar. It can jump wildly from one price to another depending on the mood of the market. You know, it's kind of like someone says, I bid $25, and then someone swoops in and says, I bid $60. It'll jump right up, and if you have your limit set at $30, it'll blow right past it. So that's the difference between a limit order and a stop loss order and some of the risks involved in each one. So we know about market orders, we know about limit orders, and we know about stop loss orders. And there's a fourth stock market order type to discuss now, and that's a stop limit order. And if everything I've been saying to this point has been making sense to you, you can probably figure out what a stop limit order is. So when you're placing a stop limit order, you'll actually enter two prices at the same time. The first will be your stop price. And just like we talked about with a stop loss order, that's the price that will trigger your stop limit order. But the difference with the stop limit order is that second price you'll enter, which is the limit at which your order will execute. So with a stop loss order, the stock is trading at $100. I decide I want to sell it if it goes to $95. I enter my stop loss at 95, and once the stock falls from 100 down, it hits 95, that is triggered into a market order. I'll most likely get it at $95 but say there's a CEO scandal and the stock is just rocketing down, I may actually get my order filled below that $95 threshold I set. So with a stop limit order, I can say I want my stop to trigger at $95 and I want my limit to be $94.25. So as the stock comes down and hits $95, it will trigger that stop, which will then execute once the price of the stock hits that $94.25. So what are the important points to remember when thinking about stop loss orders and stop limit orders? So a stop loss order guarantees execution once the stock hits your stop price that you've set. But the risk is the price at which your order actually executes may be lower than that stop price you had set, depending on the volatility of the stock and how quickly the market is moving. With a stop limit order, you are guaranteed the price that your order will execute at because you're setting that limit price. But the risk to a stop limit order is your order may not get filled if the stock is extremely volatile and moving extremely quickly. If the stock price blows right past your limit order up or down before your order executes, your order may never execute and you'll be left holding the bag on that stock. So a stop limit order may be better for volatile stocks that swing up and down a lot and have a lot of price movements because you're guaranteed the price at which your order will execute. A stop loss order may be better for something like a meme stock like GameStop, where you may have bought the stock at $40, it's now up to $120, and you set your stop loss at, say, $95. Well, if GameStop comes crashing down through $95, there's a chance it'll never reach $95 again in order for that order to execute. So with a stop loss, when it hits $95, it turns into a market order and guarantees execution. So those are the scenarios where you might want to consider a stop limit order and a stop loss order. As I mentioned in my video on market orders and limit orders, as a long-term investor, where I'm just accumulating a position in a stock or my index funds, I typically use just market orders for my purchases because the actual specific price I get at that moment isn't really going to matter to me years down the road. And a limit order may be more useful if you're a shorter term investor and you have a very specific price that you want to buy a stock at. So if you learned something about stock market order types in this video today, please give this video a thumbs up down below. It really helps the channel out, helps spread my videos to people who would otherwise never find them. Don't forget to subscribe if you're not subscribed to the channel already. And if you want to check out more videos that will make you better with your money and a better investor, check out these two right over here, and I will see you there.